You've probably heard the term inflation tossed around in news, during finance discussions, or maybe even at the dinner table. But what does it really mean? And more importantly, how does it affect your wallet and investments? Hello there, and welcome back to Market Matters Media. Today, we're embarking on an enlightening journey into the fascinating world of inflation. Picture this as an exciting expedition where we are strapping on our financial life jackets and setting sail through the captivating waters of money matters. So buckle up and get ready to sail with us. Inflation might sound like a complex term, but fear not, we're going to break it down in the simplest way possible. Imagine inflation as a force that makes the prices of things you buy, like toys and food, go up over time. It's like a gentle tide that causes your money's power to weaken a bit. Have you ever wondered why your favorite chocolate bar cost less a while back? Or why your grandparents could buy a house for the same amount you'd spend on a car today? Well, that's inflation at play. Before you start worrying, remember that a little bit of inflation is pretty normal when the economy grows. It's like a small ripple in the water. But when prices shoot up too quickly, it's like a big wave that can create some challenges for us. Imagine this scenario. Let's say you receive a bit more pocket money this year. But guess what? Everything costs more because of inflation. Even though you have more money, it can't buy you as much stuff as before. It's like trying to catch a balloon that's floating away. You're getting closer, but it's still slipping away. However, the good news is that inflation isn't all gloom and doom. It influences different parts of our lives in different ways. Now let's dive into how it impacts both your money and the investments you might have. To gain a deeper understanding of the impact of inflation on your financial situation, let's explore some concrete examples and statistics that highlight its effects on your day-to-day life. Imagine you're a college student who relies on a part-time job to cover your expenses. Over the past years, you've noticed a significant increase in the cost of textbooks, housing, and meals. In fact, data from the Bureau of Labor Statistics reveals that the average cost of college textbooks has risen by 90% over the last decade. The rise in prices can be attributed to inflation, as the value of your money decreases over time, making these essential expenses more burdensome. Consider another scenario. You're a young professional saving up to buy your first car. You've been diligently putting money into a savings account, hoping to have enough for a down payment. However, the Consumer Price Index, or CPI, a commonly used measure of inflation, shows that the cost of new cars has increased by 25% over the past 5 years. This means that even though you've been saving, the goalposts keep moving due to inflation, requiring you to contribute more money to achieve the same purchasing power. Now let's talk about groceries, something everyone needs. A family's monthly grocery bill has surged by an average of 15% in the past decade, according to data from the U.S. Department of Agriculture. The rise in food prices can directly be attributed to inflation, which erodes the value of your money over time, making each trip to the supermarket more expensive than the last. Consider the impact of inflation on investments as well. If you invested $10,000 in a conservative portfolio with a 4% annual return a decade ago, your investment would have grown to $14,802 today. However, accounting for an average annual inflation rate of 2.5% over the same period, the actual purchasing power of your investment would be closer to $12,261. Inflation reduces the real returns on your investments, underscoring the importance of accounting for it when making financial decisions. Now let's delve deeper into the relationship between inflation and investments, using concrete examples and scenarios to illustrate how inflation impacts various investment options. Consider stocks as a prominent investment avenue. Imagine you're an investor who purchased shares of a tech company a few years ago. Over time, the company's innovative products and services have driven its stock price higher, outpacing the rate of inflation. According to historical data, the average annual return of the S&P 500, a stock market index, has been around 7% after adjusting for inflation. This means that investing in stocks has the potential to not only preserve your purchasing power, but also generate real returns that grow your wealth. However, fluctuations in the economy can disrupt this relationship. Imagine a period of economic uncertainty, much like the 2008 financial crisis. During such times, companies might struggle to maintain their profitability, leading to a decrease in stock prices. This is precisely how inflation can impact stocks in the short term, as rising prices for goods and services can squeeze profit margins and dampen investor confidence. Despite these temporary setbacks, stocks have historically shown resilience and recovered over the long term. Now let's shift our focus to bonds. Imagine you're an individual who invested in government bonds, considered relatively safe investments. Bonds work like loans. You lend your money to a government or a company, and they pay you back with interest over time. However, when inflation spikes, the purchasing power of the interest payments you receive may erode. In essence, you're expecting a substantial return on your investment, but due to inflation, the real value of that return might be diminished. For instance, consider a scenario where you hold a 10-year government bond with a fixed interest rate of 3%. If inflation suddenly rises to 5% annually, the purchasing power of your interest income effectively decreases by 2% each year. This phenomenon highlights the challenge of maintaining the value of your investments when inflation surpasses the returns generated by bonds. Feeling more confident now? Great! Let's discuss some strategies to navigate inflation smartly. First, think about your sources of income. Imagine you have two ways of earning money: your allowance and a part-time job when you're older. Having more than one source of income can help you stay ahead of inflation's effects. Next, let's focus on education. Imagine you're a detective trying to solve a mystery. Learning about different investments and how they respond to inflation is like gathering clues. The more you know, the better prepared you'll be to make wise investment choices that can protect you from inflation's ups and downs. Lastly, imagine you're a captain steering a ship. Regularly checking your financial goals is like keeping an eye on your ship's course. It helps you make sure you're heading in the right direction and adjusting your plans as needed. As we wrap up this journey through the world of inflation, remember that understanding its impact is like learning a new game. It might take a bit of practice, but with the right strategies, you'll become a pro. If you enjoyed this adventure into the realm of money, don't forget to give us a thumbs up and subscribe for more exciting explorations into the world of finance. Until next time, make thoughtful money decisions and continue your exploration of the world of investments.